Are you still feeling the pinch of increased prices, the pinch of inflation, the pinch of increasing prices on goods and services? No matter where you are in the world, guys, let me know in the comments below. The United States Federal Reserve has now raised their federal funds interest rate again just a few days ago. Now, I want to talk about on this quick video, how does that impact you? How does that impact me and us as consumers? Now, I believe that we all need to know and understand exactly what's going on in the economy in the country that we live in, because that affects our money, right? And it affects what we should be doing and how we should be moving with our money. And it affects all of our plans coming up with our money. So as an investor, as a worker, as a consumer who wants to get their personal finances on the right track, on the way to financial freedom, we got to be aware. We got to know what we should be doing. So stay tuned, because I want to explain to you exactly what we should be doing right now. Now let's jump into it. The United States Federal Reserve has just raised the federal funds rate for the 11th time since March of last year. And just last month was the first time it didn't raise rates in almost a year and a half. But just this past week, they raised rates again. So with that said, rate hikes continue. And so we're clear, guys, when I say the federal funds rate, what I'm referring to is the interest rate that commercial banks charge one another for overnight lending to each other. And when the Federal Reserve raises the federal funds rate, it raises the short-term lending rates that banks ultimately charge us, because what they charge each other for overnight lending trickles down and affects us as consumers for loans that we want to take out, like auto loans and indirectly mortgage rates and personal loans and things like the interest rates on credit cards. All of those things are affected when the Federal Reserve raises the federal funds rate. Now, just to be clear, the mortgage rates are actually more closely tied to the 10-year Treasury bond. However, there's some overlap and some trickle down, and oftentimes when the federal funds rate is increased, the mortgage rates end up being higher as well. So the Fed continues to raise these federal fund interest rates, which makes borrowing money more expensive. So by raising the federal funds rate, they've just been raising the cost to borrow money in an effort to, and here's the kicker, continue to discourage and slow down spending by us American consumers. So the Federal Reserve is trying to make borrowing money more expensive so that we slow down our spending. And listen, if you're not in America, you have a central bank in your country, and your central bank oftentimes does the exact same thing that the U.S. Federal Reserve does in the United States. So there's a central bank in your country who's likely doing the exact same thing to sort of monitor the monetary policy in that country and control inflation. So here in America, the Federal Reserve has raised the federal funds rate, and they raised it up by 25 basis points, which is 1/4%. And so now the federal funds rate, the rate that commercial banks charge one another for overnight lending, is between a range of 5.25% and 5.5%. Now, here's the big deal. The federal funds rate has not been this high since 2001. So this is the highest that the federal funds rate has been, and the most expensive that money has been to borrow in about 22 years. Now that's important. That's huge. Hey guys, if you're here for the very first time, please do me a favor and consider subscribing to my channel. Also guys, please smash that like button below and let me know your thoughts in the comments. I don't care what country you're in. Are you feeling the pinch of rising prices? Or are you seeing prices sort of ease up just a little bit? Let me know in the comments below. Okay, let's get back to the video. So just about a month ago, the Fed indicated at the press conference after their meeting that they would be increasing the federal funds rate at least 2 more times this year. However, despite the Fed saying they were going to raise rates at least 2 more times this year, the stock market has only priced in about a 50% chance that the Fed would actually raise rates again later this year. So in other words, the stock market is not fully buying into what the Federal Reserve has said about raising interest rates again one more time. We just got the first increase, but the stock market is not fully convinced that the Fed is going to actually raise rates again this year. Now, me personally, I disagree with that, because the chairman of the Federal Reserve, Jerome Powell, he came out at the meeting just last week and said the central bank will be making data-driven decisions on a meeting-by-meeting basis moving forward. This means they're not quite sure what they're going to do or what their next move is, or they just simply don't want to tell us what they're going to do. But based on the numbers I'm seeing with inflation, the labor market, and other factors, My opinion is they're going to raise rates again later this year. I don't think there's any slowdown to the momentum of what the Fed has been doing. The U.S. Federal Reserve has been on its fastest monetary policy tightening campaign in more than 40 years, guys, and I don't see it letting up anytime soon. The Fed said, hey, we're going to raise these interest rates continually and make it more expensive to borrow money so that people would spend less money and the economy would slow down and shrink. And that would stop prices from increasing so fast, because that's all inflation is, guys. Inflation is just the rate at which prices for goods and services increase. Now, as we also know, we've had a strong labor market here in America because for the last 6 months to a year, the unemployment rate has been at historical 50-year lows. But we're also seeing a slight change or shift in the labor market because we see that new jobs, new non-farm jobs are decreasing, right? We're introducing to the market, to the labor market, fewer and fewer non-farm jobs. Every single month, we're seeing that rate of new jobs going down. So I think there's going to be a slight shift in the strong labor market, and it's going to begin to soften up just a little bit. So keep it in the front of your mind that the job market may be turning around, right? It's been great. Everybody's been working. There's jobs available for most people that want it, right? Been great. But guess what? That could be changing soon. And the labor market is one of the things that the Fed looks at closely when they make a decision on whether or not to raise or lower interest rates. Now, I don't think the labor market is shifting soon enough, and that's one of the reasons I think the Fed is going to continue to raise rates. Now, also, guys, remember, stay tuned because I want to tell you exactly what we should be doing right now. Now, the other thing to think about is the Fed has been keeping an eye on inflation itself. As you guys know, here in America, inflation was up to 9% last year. Now, inflation has gone down. It's between the 3.5% to 4.5% mark, depending on if you're looking at the CPI numbers or the core PCE inflation numbers, right? They differ. 3.5% to 4.5%, 4.8% is about where we are. Way down from 9%, but guess what? Not close enough to the 2% that the Fed really wants to see. The Fed doesn't seem content with having inflation around the 3.5% to 4.5% to 4.8% mark. They don't see that as being a win. That's another reason I think they're going to continue to increase the federal funds rate. So what does all this mean for you, for me, for us as consumers? And what should we be doing? The first thing we got to do is pay close attention to what's going on. That's the first thing, right? We got to know what's happening. Our job as consumers, our job as investors, and our job as workers in America is to be watching these markets, labor market, stock market. Keep in mind, guys, when the Fed raises rates, the federal funds rate, usually that means a slight dip in the stock market. Stocks tend to tick down or see sort of a downshift. Now, that didn't happen this time around, but it could happen soon. So be careful. So be looking for that, guys. Many experts are predicting that the stock market will dip. Again, in America, the American stock market this year has been up. The S&P is up 15 or 16% year to date. But just be aware that the stock market could go down. But don't move your money out of the stock market. Keep investing in the market, right? Because when the market's down, you want to be in the market still buying shares of mutual funds, index funds, ETFs, whatever it is. Still buying shares, right? Because you're buying shares that are undervalued and you want to continue to buy those shares because you're getting more bang for your buck, because when the market comes back up, you're going to be in a position to take full advantage of that increase. But stay in the market even if we see a dip in the market coming up. Also keep in mind, guys, if you're planning for the future, you're planning to borrow some money, the increased federal funds rate feeds through to other forms of loans that we as consumers want to take out, such as mortgage rates, right? Mortgage rates, again, tied to the 10-year treasury, but oftentimes the federal funds rate, when it increases, mortgage rates end up increasing, right? So if you're buying a house anytime soon, think about that. If you want to go get a loan for a car, think about the increased rate that you're going to be paying for that loan. And also if you use credit cards, credit card interest rate is in the 20s, right? 20-something%. Guys, listen. You want to use credit cards as sparingly as possible if you can, if you're not used to paying off that bill every single month and you're used to being charged interest. You don't want to be charged this greater amount of interest on that short-term loan because credit cards are short-term loans and they're affected by the increased federal funds rate. And you want to keep in mind this high interest rate environment that we're in, it's not going away anytime soon. It ain't changing. So just be aware that we're going to be paying high rates of interest, lots of money for loans. We may not see the low interest rate environment for several years down the road, guys. So our job as consumers is to understand what is going on with the money and how we should be moving and operating and planning our finances based on the environment that we're in terms of the U.S. economy and the federal funds rate. Because the goal really for us, guys, is to be a good steward and a good financial manager over our own personal finances. And the way we do that is by staying informed. It's all about growing our wealth. And so therefore, we want to continue to grow that wealth, whether the economy is down and the federal funds rate is real high or the federal funds rate is real low. Doesn't really matter. We want to be growing our money in all types of environments, no matter what's going on with the U.S. economy. So we want to be investing in the stock market. We want to be making sure that we're living on less than we make and we're living below our means, right? Our means being our income, because we want that gap between our expenses and our income to be as wide as possible so we still have money to save towards an emergency fund, to pay off debt on depreciating assets. We still want that cushion of money also to invest as much as possible into the stock market or into real estate, right? Something that's growing in value. So we want to continue to do those things. We also want to continue to have a plan and to be working that plan, right? And even if that plan is just a budget, make sure you're budgeting and make sure you're following your budget. And also, guys, we want to be making sure we're paying down debt. Again, paying down debt on things that are going down in value. So it's one thing to pay off debt, but it's another thing to actually make sure you don't take on new debt. So those are some of the things that we should be doing right now as conscious consumers. Hey, listen, guys. Keep yourself tuned into this channel where we talk the U.S. economy in plain language, but we also talk about money management, growing wealth, and doing what we have to do to help you reach financial freedom. Guys, remember, smash that like button for me, and please consider subscribing if you're not already a subscriber. Hey guys, the best person to take care of the old you is the young you. Take care of yourself and also take care of other people. Until the next video, peace!